Hello and welcome to Mint Funds Update. My name is Marek Krzeczkowski and I'm joined by Ryan Falls. Today we will talk about our market outlook and what happened within diversified funds last month. Starting with US economy, it is still going strong, but there are some dark clouds on the horizon. Firstly, starting with good news, we saw a non-farm payrolls that rose more than expected and unemployment remained at 4.2%. That was positive news, just showing that the US economy remains resilient. On the other hand, we see things like job openings trending down. Well, currently, they are down to the pre-COVID levels. Some commentators believe that this is a sign of a slowdown in the US, but at this point, it just looks like we are going back to the levels, those normal levels that we saw before we had pandemic 5 years ago. Now, financial conditions have loosened substantially in the US. Here on the left-hand side, the financial condition index, you can see how it came down from the peak last month. And as a result, we also saw recovery in S&P 500 and high-yield corporate bond spreads came down. Markets have moved to reduce the risk of recessions over the last month. Now, disinflation, we believe, should resume soon. So we see some signs when you look at services inflation, that is coming down here in the middle chart, but also wage pressures and unit labor costs are now at the levels that we've seen over the long term. So again, these used to be key risks to inflation outlook, and currently they both are trending lower. Obviously, the risk tariffs drive volatility, as we all have seen over the last 3 months. Here on this chart, I'm doing tariff announcement versus stock performance. And as you can see, we had a very volatile period between February and beginning of April, in particular, the so-called Liberation Day, the 2nd of April, when markets sold off, and 4th of April, where markets sold off substantially, and then a strong recovery following the trade talks. Currently, as we speak, China and US are negotiating in London, and we believe that the outcome should be positive for the markets. Now, why so much optimism? I think the key thing to understand why Trump needs those trade deals is the fact that if US does not make the deals sometime by the end of the summer, US faces a serious risk of recession. And what would that mean is that they would be very likely to lose midterm elections in November next year. That is the only scenario that can actually derail Trump's presidency and his agenda for the next couple of years. Now, historically, if you think about what I called here a Democrat House scenario, where Democrats control House, which is easier to win than Senate at the moment when you look at the polls, what you find is that they have ways of slowing Trump down. So one of those things, they are called riders. It's a short clause that you can put in a spending bill that says that no funds may be used to implement executive orders, something specific about executive order. So what that means is that whilst the Trump can come up with executive order, there is no funding for it. We saw a couple of examples of that between 2019 and 20. Here I just have one example of border wall funds when House controlled by Democrats basically refused to give new money for the wall and added riders against any fund transfers. And even though Trump has tried to move the funds around, basically this all ended up in courts and took months. Now, the other thing which has been it's just for agenda, if Democrats took over control of the House, is really a Trump impeachment. So there have been rumors or even discussions that Democrats have pretty much been ready to file another impeachment if they win House next year. Again, that would not be supportive for Trump, who would be very distracted with that. So overall, we think that incentives are there for Trump's administration to make those trade deals. They want to avoid the recession, which is the key risk for them. And hopefully over the next few weeks, we will see some meaningful resolution. And therefore, we remain positive on equities and bonds moving forward.
Thanks, Marek. I'll quickly touch on the New Zealand economy over the past month in May. So we had the RBNZ May MPS. So despite a 25 basis point cut, which was well signaled in advance, market commentators think this is a bit of a hawkish pivot. And this is driven off the comments made in the press conference after the fact, and also the fact that there was a 5-to-1 split in terms of a 25 basis point cut versus hold on the MPS committee. So all these things point to a potential pause in the next RBNZ meeting rather than a future cut. Now, despite all this, the chart shows the RBNZ official cash rate projections. So what we have here in the green is the latest forecasts, and then in the amber we have the previous forecast from February. So by year end 25, we had seen that the RBNZ had forecasted a 3.14% average OCR over that quarter. And then for the May meeting, which happened obviously at the start of the month, we had 2.92%. So despite all the hawkish commentary that came out, the forecast actually implied that OCR will be below 3% by year end. Turning now to the diversified funds performance, and we'll start off with diversified income fund. So asset class performance was mixed in May, as equity markets buoyed on tariff reprieves and bonds dropped globally as fiscal concerns rose. Looking at each individual asset class, we had Australasian equities up plus 0.9%, and that was the top contributor, with global equities coming in second, plus 0.7%. And then we had fixed income coming in slightly negative 0.2%. Looking specifically at the positive contributors, within global, we had Broadcom Incorporated up 25.8% and Amazon up 11.2%. Broadcom actually bounced along with the other semiconductors in May as news came through on the prospect of a US-China trade deal, reduced tariffs in the short term, so down to 10% from 125%, along with a 90-day reprieve while negotiations were ongoing between the US and China. Within Australasian equities, we have Megaport up 18.4% and SRG Global up 16.7%, and they were the top two contributors for the month. Megaport surged with the wider tech sector on renewed hopes after that aforementioned US-China trade deal. But additionally, we saw some short interest drop on some Megaport specifically during the month, and that helped support the price. Looking at the negative contributors, within fixed income, we reduced our small long duration position in the face of the decreased growth risks arising from US-led tariffs. This position was a slight drag in performance, with an example showing here the New Zealand government 2041 bond down 1.1% in price terms over May. Within global equities, we had Thermo Fisher Scientific Incorporated down 6.1%, and that was the main detractor from performance within global. Thermo struggled amidst news of further costs to funding for research and development in US universities, which in turn affects the demand for their biotech machines that Thermo specialise in. This move was further to the downgrade in guidance provided by the Thermo management in April. Within domestic equities, we had Serco down 16.7%, and that was the bottom performing stock for May. That they dropped after announcing they missed their sales target in their latest earnings report, and this was despite a backdrop of stronger travel growth. Turning now to the growth fund, so asset class performance was mixed in May, mostly with equities up, and that was, as I mentioned, on the back of those tariff reprieves, and then bonds dropped as the fiscal concerns rose. So global equities is up 3.9%, and that's the top contributor, with Australasian up plus 1.0%, and then fixed income came in flat. So turning to the positive contributors again, within global equities, we had Broadcom again up 25.8%, and then Oracle Corporation up 17.6%. Oracle bumped on wider sentiment boost in the tech sector, but specifically on a number of positive news items for the company, including they are providing AI tech to Canadian healthcare organizations, cloud security software to the US government, both local and federal, and then also its announcement of 14 billion capital injection into Saudi Arabia tech sector. Within Australasia, we had Megaport again, plus 18.4, and SRG Global up 16.7. The SRG Global price appreciation was driven off an analyst upgrade for the month, and a slightly dovish RBA meant that the value of their long-term infrastructure assets increased with a slight fall in rates. Turning to negative contributors, again, we had our fixed income. We reduced our small long duration position in the face of those decreased growth risks rising from US-led tariffs, and that position's a small drag in performance, with the government for 2041 bond down 1.1%. Within global equities, with Eli Lilly was down 17.9%, and Thermo Fisher Scientific was down 6.1%, and they were the two main detractors for performance in May. Eli Lilly dropped after earnings at the beginning of the month, in which they slashed their guidance for their profit outlook for the year down $1.72 per share. And again, then within domestic equities, we had Serco down 16.7%, and they dropped after missing those sales targets announced in their latest earnings report. And that's all from me.
Oh, thank you for listening. If you have any questions, please send them at info@mintasset.co.nz.